Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is May 15th of 2023. And what we're going to do this week is continue to stay focused on some of the shorter term anxieties of the market, such as the US debt ceiling, what it means for overall asset allocation, and really some of the warning signs that we've seen that have been bubbling up in the market really over the last, I would say, 3 or 4 months, and it's reflective in our portfolio design. We're relatively flattish for the year here as we look across our portfolios, and that's by design and for a reason. And we're going to talk a little bit about why we still are avoiding technology despite some of the strength that we've seen in that sector year to date. So let's go ahead and get started. The title of this week's presentation is Something is Happening, right? And when we look at the symptoms of the market, there's a lot of yellow signs out there that sort of give us pause, right? The market has rallied since that October low, but there's a lot of things that are just not following through that you would tend to expect with a robust and healthy bull market rally. And we're going to go through all of those. So the big three things that we want to focus on this week: US default risk continues to rise. What does a deal mean if and when they come to a deal? They being Congress. We believe that the bank mess goes well beyond the regional banks, and we're going to go through a little bit of that this week. Lastly, the stock market remains very narrow right now, and that's an important point as we look at the world and how we look at the portfolio. And you're going to notice the portfolios, whether you're talking about the blue chip or the opportunity, tend to be fairly concentrated in a handful of sectors right now, and because of what we're avoiding on the other side of that equation. So when we look at the world right now, we see a world where global rates are falling. So right here, what we see is this is the 10-year yield in the black line, and this is the 2-year interest rate. So in other words, we do have an inverted bond curve that remains in place with 10-year interest rates remaining below 2-year interest rates. But the bottom line message here is that rates have really fallen over the past month and a half. We've gone from over 5% on the 2-year down to 3.98%. This is the more important point. The federal funds rate is just around 5%. So the 2-year yield is trading at a 100 basis point discount to the federal funds rate. So historically, when you've had about a 1 point or a 100 basis point spread between federal funds and where the market is, that has tended to occur around times where the Fed is not necessarily on the same page as the rest of the market, and something has to give. Now, what's happening in the rest of the world? We look at the 10-year yield in China, complete collapse. When we look at South Korea, complete collapse. When we look at Brazil, falling. When we look at Mexico, falling. A lot of these head and shoulder patterns that from a technical standpoint are not things you want to see if you're on the side of wanting rates to go up. So why do rates typically fall? Well, one could be deflation or disinflation. The other could be weakening growth. And we think we're experiencing a little bit of disinflation and a little bit of the weakening of overall growth. And we do think inflation continues to ease. Like we said, that path from 9 to 5 was a lot easier than the path from 5, 5.5 down to 3 or 2. So it's going to be very grudgingly easing back, but nevertheless a path of easing. And so what's interesting is after the recent inflation reports, after some of the recent employment reports, what we've seen is the odds of a June hike have fallen to 1% from 12% just a few days ago. In other words, the recent inflation report pretty much puts the Fed on pause. So we're in the Fed is done raising hikes camp. And when we look at what the market's pricing in, you can see here 1.2% chance of a Fed rate hike, so in other words, a pause. But then notice what happens after. Almost the market is now saying that the Fed is going to start cutting rates in the back half of the year. And we don't necessarily disagree with that view. And a big reason why is because of what's happening in the Treasury bond market and what's happening with the banks. And we're going to go through that right now. So we've brought in this, we have shown this chart a few times over the last few weeks. And I think it's one of the most important charts out there because everyone's kind of poo-pooing it as not that important. The fact that U.S. credit default swaps, in other words, protection against U.S. default, is at 176 basis points, as we see right up here. That's really, really important because back in 2011, when sovereign credit got downgraded, that peaked out at around 75 or 80 basis points. We're now at 176. In other words, the market is saying there's a 3% chance that the U.S. is going to default. That shouldn't be 3%. That should be 0. So the fact that it's at 3, the fact that this credit default swap is trading at a wider risk premium than Bank of America and the banks in general should say something, should say to us at the bare minimum, maybe there's something here that the market's not seeing, or that this specific area of the market is seeing that the rest of the market is not. We want to be careful. Now, gold got hammered, or gold stocks got hammered on Thursday. If you own the opportunity strategy, you would have seen that. After a pretty good run over the last couple of weeks, Thursday was a bad day, but then they bounced back on Friday. But that, we're not too concerned about that because you get these one-day profit-taking events. Meanwhile, this is happening unabated. And we look at gold, and gold reminds us a lot of that post-08, 09 time period where we had this dip, we had this rise, we call this a reverse head and shoulders, and then blast off. A very similar pattern this time around. We were having this dip, and now we're seeing this rise again. And despite Thursday, I mean, this is just a mere blip compared to other dips that we've seen in the past. And so we do think that gold is very well positioned in this type of macroeconomic environment. And then the important question that we're really trying to answer is, how can the S&P 500 really rally when we think about it, when the banks and the small caps are not participating? So we said here is, actually, we got this from a research firm called Strategas. When the S&P 500 previous lows, so in other words, the S&P 500 establishes a low and starts to rally, right? So on other big lows in the market, what was the performance of the S&P 500 7 months off a low versus small cap stocks and versus the banks? And are there any anomalies in terms of what that performance looks like? So we can see here, the S&P 500 is up 15.5% off the low. That sounds great until you look at historically, the other major lows, 49%, 21, 29, 35, 18, 50, 27, 28, 55, right? So big reason why, by the way, we ask clients not to panic during bear markets, because the first 7 months are critical to recovering your losses. But on this particular one, we're up 15.5%. Small caps are only up 3.4%. And this is important for two reasons. One, it's a lot lower than, if you just have to eyeball this to see, it's a lot lower than historical. But then the other big reason is that small caps historically outperform the S&P 500 off the bottom. Why? Because they're riskier, right? You get more beta or operating leverage on these small companies than you do with larger companies. And so the fact that it's only up 3.4 while the S&P is up 15.5, that gives us pause. And then we look at the banks. Again, S&P 500 up 15.5. The banks are down 22.6%. Now we know that the explanation out there is, well, like, that's just the regional banks, right? They're sort of contained in this little bubble while the big banks are the winners and all the other financials are fine. Maybe, but we're going to go through why that's not necessarily true. So again, the banks tend to outperform off market bottoms versus the S&P 500. Not only are they not outperforming, but they're getting annihilated. And this is the regional banking index. No surprise here for anyone that's been paying attention to the market over the last 3 months. You will know that we have no bank exposure. That's by design. We're happy about that. But I would argue or surmise here that this is not the only part of the bank problem. It is not contained to the regional banks. These are the big banks. So when we look at Bank of America, we look at Morgan Stanley, we look at Goldman Sachs, we look at Citigroup, who's not on this chart here, we look at Wells Fargo, all of these charts are plumbing new 52-week lows and they're breaking down. The only bank left standing at this point is JP Morgan. We think it's just a matter of time before JP Morgan joins the gravity crowd down to 52-week lows. So despite the fact that all these banks are so-called winning, these big banks are winning deposits, their stocks are getting annihilated. They're getting killed. And guess what? It's not just the banks within the financials. The insurers, the life insurers, the property and casualty companies, they're getting killed as well, right? So the blue chart here is MetLife. You see a huge drawdown from 240 all the way down to 155. That's a 33% or so sell-off. You have Prudential that's gone all the way from 220 down to 145. Again, these are big sell-offs that we're seeing in these stocks. So this idea that it's just the regional banks is false. You're seeing big sell-offs in the major money center banks. You're seeing big sell-offs in the insurers and the property and casualty names. In the magnitude of, no, they're not down 5, they're down 20, 30, 40, 50%. These are big moves. And then we look at Bank of America credit default swaps. They're near 52-week highs, right? This was the panic during COVID. Strip this panic out, and we are near 5-year highs on credit default swaps. So in other words, people are starting to make bets that the pain is spreading beyond the regional banks to the big banks. I think this is important because it goes down to this question of, can the S&P 500 rally when you have the banks and small caps that are selling off? And when we look underneath the hood, what I wanted to show people here is the blue line is the S&P 500, right? So it looks done okay this year, right? Up 6% or so, 6-7%. Not bad, right? I'll take that. Considering we're flat, right? So I'll take 6 or 7%. But look, this is the S&P. The black line is the S&P 500 equal weight index. So in other words, Apple's not like 10% of the index. Google's not like 10% of the index. Every single stock from Google or Fastenal or Johnson & Johnson, they're all the same weight. That's what the equal weight index is. And you notice the S&P 500 equal weight is actually down this year. So I want you to think about that for a second. The S&P 500 equal weight is down, even though the S&P 500 is up. And that's because we're in one of the most narrow markets in stock market history. If we look at the breakdown of the performance this year, we can see industrials down, energy down, oil field services down, utilities down, consumer staples down, real estate down. It's only tech, and specifically the FANG stocks. So your Facebook, Apple, Amazon, Netflix, Google, etc. Those stocks are carrying the market, right? Now, we're not in those, and for those of you who know us and have been watching these weekly updates, we're not there for a reason, because when you have a market that is so narrow, at some point the generals get shot, right? And so you may ask, well, if you don't like the market, the narrow components of the market that are working, and you obviously don't like the rest of the market that's already selling off, then what are you doing? Well, there's a place to make money in our belief. And we look historically in this type of market, when credit risk is rising, when growth is starting to slow, when inflation is decelerating, those combinations tend to lead to lower interest rates and a weaker US dollar. Gold and bonds amongst other hard assets, we would actually, a bit of a contrarian here, we'd actually think energy can work in this environment as well, tend to do well in an environment where rates are falling, inflation is coming down, and more importantly, that US dollar is coming down. And so we look at that portfolio right now, very overweight gold, very overweight energy, hard assets, as well as a little bit of cash on the side. So that's the game plan in terms of where we're at right now. That's where we see the market rotating toward. We see a very narrow market where underneath the surface, the banks are breaking down, the insurers are breaking down, small caps are breaking down. We have 0% exposure across those troubled spaces, but that cancer is starting to spread. And it's very rare to have a bull market where the banks are not at least stable or rising. And so what can do well? We think gold is where energy was a year and a half ago. We think gold can rise significantly from these current levels, and that's represented in the portfolio design right now. So if you have any questions or concerns, feel free to give us a call, 888-543-3776. Have a great week, and we'll talk again next week.